Welcome to the latest Hardman Talks on Chesnara. I'm financials analyst Brian Moretta, and today we're joined by Chesnara's Chief Executive Steve Murray and CFO Tom Howard. We will start with Steve and Tom giving a short presentation, which we will follow by a Q&A session. Over to you, Steve.
Thanks, Brian, and thanks everyone for joining. I thought I'd start by recapping the focus strategy that we have here at Chesnara. And this hasn't changed since I've become Chief Executive, and has been a real ballast to the execution that we've seen over 2024. So firstly, we seek to maximize value from the in-force business that we have across Sweden, Netherlands, and the United Kingdom. And that's very important to ensure that we provide the right levels of service to our customers, and we deliver on the promises within their contracts. Secondly, we seek to acquire books of business across Europe. And this has been another successful period of M&A execution for us, with a deal done at the end of December, our second with Canada Life. And our third strategic priority is the writing of focused new business where we can make a profit. And again, we've seen stable delivery across the period, with both Sweden, Netherlands, and the UK contributing to the result. And all of that's underpinned by our desire to become a sustainable Chesnara and ensure that sustainability is embedded right the way across the group. So let's turn now to the financial results, which Tom will cover in a little bit more detail shortly, but it's been a strong period of delivery, both financially and operationally for us. We saw material increased cash generation, continued strong solvency, an increase in the economic value of the group, stable new business contribution, and we yet again announced a 3% increase in our dividend, and that's for the 20th year in a row that we've increased the full year dividend. And our dividend track record is the best in UK and European listed insurance. The strong cash generation that we're able to generate from the in-force book and then add to from acquisitions and new business has meant that we've had a very strong track record of that stable increase over the period of time. And that level of dividend increase has substantially beaten longer-term rates of inflation. Looking at the operational delivery that we've achieved, I mentioned before that we completed our second portfolio acquisition from Canada Life. That was £2 million of consideration, and we're expecting an 11 million increase in the economic value of the group. So we think that acquisition was done at a nice return level for shareholders. We had previously announced an acquisition from Canada Life, which was an individual protection portfolio in the UK. And I'm pleased to say that the migration of that book is now complete, as is the transfer of policies from their insurance company into ours via something that's known as a Part 7 transfer. One of the other things that we've announced as part of the full year 2024 results is that we're in the process of merging our Dutch businesses, and we expect that to generate opportunities for cost and capital synergies. And we took the opportunity at the end of Q4 to take some action on the cost base in Skilden, and that generated around 1 million annual run rate of savings. On management actions, we renewed the group hedge and actually made that more efficient. So we've got good protection from FX volatility when we think about the surplus emerging in the group. And we also expanded the existing UK mass lapse reinsurance that we had in the UK. Both of those actions have added positively to the results in the period. And we've got a strong pipeline of additional management actions that we can take that gives us certainty around the potential for paying dividends in the future. And finally, on sustainability, we've continued to make progress, and we're on track to deliver both our 2030 and 2050 finance emissions targets. And we also improved the ratings that we have with some external agencies. And if you want to see more, you can look at our annual sustainability report on our website. So with that, I'll hand to Tom, who will cover the financial results in a little bit more detail. Over to you, Tom.
Thanks, Steve. And look, as Steve mentioned, really pleased to be announcing a strong set of results for full year 24 for Chesnara. And by way of reminder, when we think about the financial performance of the group, we look at it through three lenses. So firstly, how much cash are we generating? Secondly, what is the strength of the balance sheet? And then thirdly, what is our outlook for future value and cash generation? So from a cash perspective, we reported cash generation of 60 million, which is a 14% increase year on year, and provided significant coverage against dividend at 1.6 times. From a balance sheet perspective, our solvency ratio remains strong, so at 203%. That is significantly above our normal operating range of 140 to 160%. And what that does is, in addition to giving us balance sheet strength and the ability to be resilient against a range of different macroeconomic conditions, it also gives us and allows us to retain firepower to invest back into the business, but also to pursue M&A. And then from a future perspective, we have an eye on the long term and basically the outlook for future cash generation. And really pleased to see that the economic value of the group, which is the real indicator of future value, also increased over the period to 531 million. Additionally, we're seeing significant growth in our assets under management. And again, that is a predictor of future cash flows. So as our assets under management increase, future margins from those funds, in particular the funds that our policyholders invest in, are a precursor to future cash generation. So taking all those aspects together, that has allowed us to support an increase in the dividends by 3%. And as Steve mentioned earlier, this is the 20th consecutive year of dividend growth. So I mentioned a moment ago that the outlook for future value and cash generation is a very important aspect of how we manage the business here at Chesnara. And what we've set out here is a graphic that just outlines that in hopefully a pretty simple and digestible way. So if I move from left to right, the three components we have that make up the group cash generation are repeatable, sustainable sources of future value. So the risk margin and SCR release is the value that is generated by the runoff of the in-force book over time. That is a highly predictable source of future surplus for us, and we have a high degree of certainty around the level into the long term. Secondly, on investment returns, when we look at the valuation of the business, we assume very prudent future levels of investment growth. And to the extent that the actual investment returns in the market exceed those prudent levels of growth, we recognize additional surplus. And then thirdly, we exercise management actions. And management actions are tools we have at our disposal to increase the value of the business. And for example, in 2024, we took the opportunity to exercise two management actions, one in relation to foreign exchange hedging, and the other in relation to the extension of existing reinsurance arrangements within the UK. And that was another source of future value for us. We expect that these management actions will be a recurring feature of the business, and we have quite a few of these actions at our disposal to dial up in future years. In addition, Steve mentioned, we wrote new business over the period and we secured an acquisition, and that is another feature of the business that we expect to recur in the future, and that also supplements the future cash generation profile of the business. So when we take all of those aspects together and we look at those future value sources with a high level of confidence that into the long term, that those sources of cash and value generation will more than adequately cover our future progressive dividends and the debt cost of the business. So with that, I'll pass back to Steve.
Thanks, Tom. We thought this slide might be useful for investors and other people interested in Chesnara as a summary of some of the things that we've been doing over the last 3 years to lay the foundations here for further growth. We've done 5 acquisitions in the last 3 years that have added around 60 million of economic value. And alongside that, we've deployed just over 100 million of capital. And that was following the raising of our Tier 2 bond back in February 2022. We've taken further actions to ensure that we can finance efficiently acquisitions and further strategic activity. We've also been improving the sort of talent base that we have across the organisation. We now have new chief executives in place across the 3 territories that we operate in, as well as Tom having joined as the group CFO. And there's more to do, including the Dutch merger that we've announced as part of the results, which we expect to generate further cost and capital synergies going forward. We're also moving forward with SS&C in the UK, our strategic platform provider, and having completed 1 successful migration, we expect to complete further migrations during 2025 and into 2026, which should create a far simpler UK business operating model. So overall, we think it's been a busy period and there's more for us to do. M&A is clearly a very important part of the strategy here as Chesnara, and we can see the value benefits of that from the previous slide. As Tom and I have both highlighted, we completed a further acquisition at the end of December with Canada Life, and we're seeing further opportunities already to work on in 2025, and we start 2025 with a very strong pipeline. When we map out our pipeline over the next 3 years, we're seeing opportunities both in the UK and wider Benelux, including the Netherlands, that we think are attractive and will be worth us assessing. In Sweden, if we look at a 12 to 18 month view, there may be opportunities for a look at in 2026 and beyond, but we're seeing less in the immediate term for us to assess. Overall in the market, we think the competitive environment is a good one, and the competition now versus 3 years ago has lessened. And we continue to have competitive strengths that mean that we're a good buyer of businesses. And taking all of these things together, we think we're in good shape to execute M&A going forward, having the financial resources, the capability, and the track record around M&A. So in summary, it's been a strong period of delivery at Chesnara. We've seen strong financial results with 60 million of cash generation. We've had M&A delivered again in the year. The Dutch merger is underway. We have a clear line of sight to many management actions which should supplement the cash generation of the group. And in 2025, we're already working actively on M&A acquisitions. If you'd like to see the full results presentation in detail, you can go on to chesnara.co.uk and you can see the webcast and some of the wider materials. But thank you for listening. And Brian, I'll hand back to you.
Thank you very much, Steve and Tom. And I think a big well done on producing what looks like a very good set of results. So we're very pleased to see Chesnara making progress. On the questions, I think we'll start on M&A, as this seems to be the area that a lot of people are particularly interested in. So congratulations also on the latest Canada Life deal. It looks positive. In the results announcement, you announced that there was going to be an uplift to the gain. So previously it was 8 million, now it's going to be 11 million. Can you maybe explain what changed between December and the results statement?
Yeah, Brian, I'm happy to take that. Look, absolutely very, very happy with that deal. And obviously great to see a deal coming on the books, which is immediately accretive from an economic value perspective. The main reason for the uplift in economic value is really down to the expense efficiencies that we secured from the SS&C platform in the UK. So basically, when we're pricing the deal, we made various assumptions around the cost of managing that book. As it transpired, and we basically brought the book through our year-end process, and we got into the detail of how we would administer those policies. We saw some more of those efficiencies, SS&C-based efficiencies, coming through the valuation, and that's ultimately what has allowed us to record a higher day one economic value uplift from the deal.
Excellent. Well, it's good to see SS&C producing some immediate benefits as well. While the new deal is welcome, I think we would probably say it's perhaps a bit smaller than we all hoped for. Can you maybe give an update on what's happened in the M&A front over the past sort of few months, where the big deals are? And you sort of mentioned one or two things on the prospects, but if you want to add any color to that, that would be great.
Yeah, and I know you dialed into our results presentation, Brian. There was a lot of focus from analysts and investors on M&A, as you rightly say. So if I look back at 2024, first of all, it was a very busy period of activity for us. Probably the biggest period of activity on M&A since I joined the business over 3 years ago. And when we spoke to the market at the half year last year, we talked about the fact that the weighted average of opportunities that we were working on was a bit bigger than you might have seen from us historically. So while that was pleasing and there were some interesting things to look at, ultimately some of those things that we're working on didn't happen. And the reason for that was different across the different opportunities. But to give people some examples, so one opportunity where we'd largely got through the due diligence, we were into legal negotiations, there was ultimately a change in strategic priority from the seller. That can happen from time to time. It might be that book of business sort of comes back to the market later, but that's always a risk that you have when you're running processes, particularly whilst these books can be quite large for us, they tend to be quite small for large global insurers who are sort of looking across territorial strategies and group strategies, which can change quite quickly. And then on some of the other deals that we worked on, one particularly as we got into due diligence, it became apparent quite quickly that some of the assumptions that we've been asked to price the deal on were different to the data that were being shown. And whilst we were working hard with the other side to try and sort of narrow that value gap, as we got into further information, that became too difficult to do, and we weren't prepared to take a lower return from that business. So ultimately, that deal hasn't happened, and that can again from happen to time to time. That's why it's important that we remain disciplined in our approach. We do the right sort of due diligence. Looking at 2025 has started quickly already. We've got our teams working actively on opportunities. Will those things come off? As you know, Brian, I've got a lot of grey hair, and viewers can probably see that. And I certainly won't be predicting if and when things might land. But we see nothing from both the market competitiveness environment, given the number of things that are coming to market, and also the position that we're in terms of being able to take on books operationally and finance them, which leads us to believe that we shouldn't be successful on opportunities going forward. So we're busily working away, and obviously we'll update people as and when we've got further information. The weighted average, again, that we're looking at of this sort of pipeline that we're looking at the moment continues to be a bit bigger than the things that we've looked at before as well, just to give you a sense of the sort of things we're looking at the moment.
Okay. Well, hopefully we will hear more news in the near future. But for the moment, I'll turn to operations. And I think the big news in the results statement operationally was perhaps the forthcoming merger of the Netherlands operations, Skilden and Vaard. So I think while the motivation is clear, I think there's maybe a question about why you're doing it now in particular, and if you can flesh out a bit more on sort of the benefits that we're likely to see from it.
Yeah, so there's a few things that have led us to sort of doing this just now. One of which was we'd had a couple of acquisitions that we're integrating into Vaard. And actually, we felt the right thing to do was to sort of complete that process, embed those acquisitions, and that gave us sort of a clearer set of platforms then to look to bring together. We've also been recruiting into the senior leadership team in the Netherlands as well. So we have a new CEO and a new CFO in the Skilden business. So actually being able to be clear around who's going to run the business going forward, we felt was important, particularly when we started to engage the broader population that we have in the Netherlands, and we started to do that at the back end of last year as well. And so sort of with those two things in place, we felt was the right thing to go forward. And also we've given ourselves enough comfort that we've got flexibility in our plans, so that if acquisition opportunities coming along, we believe that we'll still be able to strongly look at those alongside doing the merger as well. And I think that would have been a potential concern perhaps a few years ago when we started to look at this opportunity, as to if you were doing the merger, would it sort of take you off the pitch from doing acquisitions? And we don't believe that's the case at all. The teams are making good progress. We've made the requisite sort of regulatory filings. A number of the approvals that we need have already come back, and they've come back more quickly, which is really pleasing, and I think shows the strong relationship that the local teams have with the DNB. In terms of the sort of benefits, we haven't sort of given a lot of guidance on that at this stage, not least that we're going through regulatory approval, and that the legal merger itself will only happen at the half year, and after that we'll start to look at merging processes and things, albeit we'll have a merged management team at that point. But to give a sense of the size and scale that could be available to us, so we did some restructuring in Skilden at the end of last year, and we took out around about £1 million worth run rate of cost, and the capitalized benefit of that is just under sort of 10 million. So thinking about what we might do with the merger, you can imagine certainly cost savings of that size and scale, if not more. And we may see some broader diversification benefit as we pool assets and liabilities in the same legal entity. And there's also some opportunities for us to look at the investment strategies that we have, which again could provide some value upside as well. So I'm really pleased with the work that the teams have done. We remain on track to have that merger, and we'll certainly give an update on progress as part of the half year results when we present those later on in the year.
Okay. I'll look forward to that as well. We've obviously got to look at some of the more problematic areas as well. And I think lapses in Movestic have been a concern for some time. Can you maybe give us an update on and whether there's any signs of improvement yet?
Yeah, so in terms of that sort of transfer out environment in Sweden, and actually we saw this for people that have been around the UK market for a while. When the retail distribution review came in, there was a change in broker behaviour as well in the UK, where IFAs started looking at the books of business that they had a little bit more closely and sort of moving those between providers. So the rate has certainly come down since the sort of high point a couple of years ago. It's still higher than we would like. What's been pleasing in the period is that the sales performance has been very strong. So we've seen really strong inflows coming into the business, and that provides obviously a natural offset if you're losing a little bit more business out of the back door than you might like. And actually, what the team have also done is manage in Sweden. They've managed the cost base very well. So we've actually seen some cost efficiency coming through the financial results. So between that and the new business result, that's more than offset any sort of negative coming through from transfers. But we're continuing to work hard on retention activity and those sorts of things. But the fact that actually we've been in a position this year, Brian, to sort of commercially overall show sort of positive operational performance is really helpful for us.
Good. Well, hopefully we can see further improvement there then. Turning to capital and cash, this was a good set of results for cash generation and capital. The latter we see has been somewhat above the target range and now has been for a couple of years. Is there a point where, in the absence of substantial M&A, that becomes a concern? And how do you think about that, how that interacts with the dividend and its growth rate?
Yeah, I mean, so Brian, it's not a concern. We like the flexibility that gives us. I mean, I think, as I mentioned earlier, having a significant level of solvency surplus just gives us the flexibility and the agility to pursue M&A opportunities, but also actually invest into the business as well. And I think it's important to have that. We do look at the dividend in the context, obviously, of our solvency surplus levels. We're very, very proud of the fact we've increased the dividend for 20 years, and we know it's an important aspect, for our investors as well, the continuation of our progressive dividend policy. But look, right now, there's a linkage here, really, I think, back to what Steve was talking about around M&A firepower and M&A opportunities. So the opportunities that we are working on, that we see ahead of us, we believe are attractive, both from an operations standpoint, but crucially from a financial standpoint as well. So actually, preserving excess capital to pursue those opportunities, we feel, will deliver greater levels of long-term return for our shareholders going forward. So as of now, absolutely no concerns about the level of surplus, and we think actually it puts us in a very, very strong position to capitalize on some of those attractive opportunities in the near term.
Okay, well, I say hopefully we will see some of those. So I'm going to finish there. So thank you very much, Steve and Tom. If you want to read more about Chesnara, then look at our note on the results on our website, along with all of our other reports, and that's at hardmanandco.com. If you want to get all future Hardman Talk videos, just press the subscribe button now. Thank you very much for listening, and we look forward to being back with you in the near future.